We got to talk about Credit Suisse because there is a disaster happening with Credit Suisse, and it's not good because Credit Suisse is a, let's just say, hugely big bank, and this sucker is down 25% in the pre-market right now. And let me just kind of show you how big this sucker is because it's a problem, okay? First, I'm going to show you this chart of bank failures. And what I want you to pay attention to is the circles, okay? So right here, you could see the Washington Mutual Bank failure circle at $307 billion of assets. Then you have a bunch of other bank failures right here, which are like insignificant, like 440 banks that failed between 2009 and 2012. Nobody cares. Then over here, you got some miscellaneous bank failures. You got Silicon Valley Bank and Signature Bank over here at $209 billion, $110 billion, okay? So those are the circles. Credit Suisse, my friends, is 5 times as big as the Signature Bank circle. It is 2.5 times as big as that Silicon Valley Bank circle. And it is about 60% larger than that Washington Mutual failure. So in other words, a lot of people are freaking out that this banking failure from Silicon Valley Bank is basically just the start. Okay, remember this. In the last week, we had 3 massive banking failures: Silvergate, Signature Bank, and Silicon Valley Bank. 2 of those were the largest bank failures since the 2008 financial crisis. They both happened within the last week. Now, Credit Suisse, which has already been in hot water, and their stock has basically been straight down. Like you thought Tesla was an easy short, there's been nothing more easy to short than Credit Suisse over, I hate to say it, but a very, very long period of time. I had to zoom out to the week chart, to show you on Webull here how bad it's been. Like this right here is the 200-week moving average, and the 200-week moving average is basically straight down, okay? Why? What is going on at Credit Suisse? And could it potentially create more contagion? Well, spoiler alert, yes. The Federal Reserve's by the effing pivot facility, that's not actually what it stands for, but it is the BFTP facility, only has about $125 billion of available capital to bail out banks. Now, it's possible the Fed could leverage that 5 to 10x or maybe even more, kind of like they did during COVID. So that facility could be leveraged up, and then there could be more money, but ultimately that's just going to be money the taxpayer has to pay back. So anybody who's telling you that this is not a taxpayer-backed bailout has no idea what actually is going on. All you have to do is follow me on Twitter at RealMeKevin, and you can actually see the actual Treasury facility that backstops what the Fed is doing. And guess where that Treasury facility gets money? From taxpayers via congressional appropriations. Okay? Yes, technically right now it's not a taxpayer bailout, but it's backed up by taxpayers. Anyway, so if it gets worse, taxpayers. Something goes wrong, taxpayers. The taxpayers are guaranteeing the bailout, basically. But anyway, what's going on with Credit Suisse? Credit Suisse is a Swiss bank with $578 billion in assets. In other words, it's a too big to fail bank, and the sucker is failing. It is facing a crisis, as the largest shareholder of Credit Suisse has just ruled out assisting the bank any further. The bank's 1-year credit default swaps are now trading near an insane level of 1,000 basis points. That's insane. We'll go into a little bit more on that in just a moment. But basically, the largest shareholder announced they can't provide any more financial support, and now the stock's down like 26% in pre-market. It's probably going to crash throughout the day. It's just not good during this whole banking crisis because it's suggesting that, hey, we thought the banking crisis was over, but wait a minute, there's a big dog in the room that could actually still be on the brink of failing. They were failing before Silicon Valley Bank, and they're still failing afterwards, and they're like 2.5 times as big as Silicon Valley Bank. Now, this development comes obviously after a ton of the financial scandals that Credit Suisse has been associated with, including Greenshill Capital and Archegos Capital Management. Remember Archegos? Complete disaster. That was like one of the biggest failures of basically somebody having about $1 billion in assets, being able to YOLO yeet them up to like $20 billion in assets and then lose everything. Yeah, how to go from 20 billionaire to bankrupt really fast. Anyway, that was a disaster. Credit Suisse was associated with that heavily. But anyway, it's important to note that in November of 2022, Credit Suisse issued 46.2 million shares to existing shareholders, raising about $4 billion in capital to try to strengthen their capital position. That was extremely dilutive to shareholders. Right now, the stock only has about a $10 billion market cap left. Back in November, which was about 5-ish months ago, it had about a $20 billion market cap. So you basically diluted shareholders by around 25%. However, the current refusal to add additional assistance is starting to make people wonder if this bank is ever going to recover. It's kind of like when a founder puts money into a startup and, people are like, oh, that's a good sign. Like they really believe in the startup, right? Like me, I have a housing startup and I'm literally risking my entire net worth on this startup. Like if this startup fails, I could go bankrupt. And then it's just like, wow, okay, yeah, you're putting a lot of faith on that startup. So I need to make that sucker work, right? But like if a founder stops supporting their startup or like a biggest shareholder stops putting money in, you kind of start scratching your head like, have they hit that point where they're like, this is a sunk cost? We cannot be a victim of the sunk cost fallacy. The sunk cost fallacy is the principle of we've put X dollars in, but we should not, the sunk cost fallacy is basically, well, we already put so much money in, well, let's just put in more because, if we stop putting money in, we're basically walking away from our investment. And that's kind of what's happening now. They're stopping putting money in. Anyway, I won't go with many more analogies. I think you understand the sunk cost fallacy. So anyway, now, the crisis of Credit Suisse, because the Swiss bank, is having a ripple effect on the European financial sector. Shares of banks have plummeted to fresh record lows, contributing to a broader disaster in the European bank stock ETS. And the ongoing struggles basically at Credit Suisse are heightening instability around the entire financial system in the United States, not only leading the stock market and bond market rather now to price in 100 basis points or a full 1% cut in interest rates by the end of the year, but they're also starting to make people wonder, is this 2008 all over again? Michael Burry made this seem like yes. Michael Burry's like, Silicon Valley Bank is just the tip of the iceberg, but everything is rhyming like 2008 and 2000 did, the dot-com bubble, and this isn't good. This potentially is setting up for another banking financial crisis. And that's kind of being seen, at least for Credit Suisse, in the pricing of their credit default swaps. Okay, now CDSs, credit default swaps, are basically a financial instrument that work like an insurance policy. It's kind of like an option, but a little different. It's basically a contract where one party pays a premium to another in exchange for protection against the risk of a specific credit event happening, like a default. If the specific event occurs, the party providing the protection pays out the other party. It's a hedge. It's kind of like an option contract, okay? Now, in the case, but they're not as regulated, and this is why we kind of had the 2008 financial crisis, because they're kind of arcane and not as regulated. They're derivatives, okay? But so are options. They're derivatives. But anyway, in the case of Credit Suisse, a one-year credit default swap is now sitting at 1,000 basis points, bips, which means it basically costs $1 million to insure against $10 million worth of the bank's debt defaulting. That's insane. It's a massive premium for a credit default swap. And it shows how expensive it is getting to protect against this disaster, because as the disaster gets more and more real, the more expensive it gets. So basically the bond market and the credit default swap market is telling you we screwed. And the ripple effects of potentially Credit Suisse failing would be probably 2.5 times as big as the failure of Silicon Valley Bank. Not only that, but remember, when we had Silicon Valley Bank fears, everybody basically flocked to JP Morgan and Bank of America. Bank of America is bragging about how they just got $15 billion of inflows. That's a lot of money in inflows, right? Well, if Credit Suisse goes down, it's going to be even worse, because that's nearly one of the top 8 banks. That's insane. It's a huge bank. So anyway, this is sparking discussions about disclosure requirements over recent reporting weaknesses. They're actually literally disclosure weak. Like, they just disclosed that they lack confidence in some of their prior financial reporting. That's like the last thing you want to tell your shareholders. And so Credit Suisse is trying to deal with not only poorly reported financial disclosures, a falling stock price, their largest shareholder who doesn't want to bail them out anymore, but also their exposure to a lot of high-risk businesses, which is bad. Because if a lot of your loans are to high-risk businesses during a financial crisis, well, things could get worse as basically people default on those higher-risk loans, which is really bad. So in other words, long story short, Credit Suisse is sucking. It's been the easiest short for the last years. It's basically going straight down. And the best thing that you could do is join the programs on Building Your Wealth, link down below. I can't advise being short these because I can't give you personal financial advice. But I mean, if you just, I mean, look at this. This chart goes, this is the 200-week moving average going back to 2017. Dude, it's straight down. Certainly since 2021, it's been straight down. I mean, go to the day chart. This is the 200-day moving average now. This is just sad. It's just trending to zero. It's going to $1.80 in pre-market, down about 28% right now. So even though we had good PPI numbers and retail sales numbers this morning, the market probably is moving down on fears of financial contagion, largely in part due to what's going on with Credit Suisse. So that gives you the latest on Credit Suisse and what's going on there. Check out the linkos down below.